Well, there certainly is another side of the coin. And for that, let's bring in Scott Minerd. He is Guggenheim Partners Global CIO. He joins us on the phone tonight. Scott, welcome back.
Oh, it's great to be on, Scott.
Good to have you. Mr. Sandler, Lasry, Reeder, they're no slouches. What's wrong with what they said?
Right. Well, look, I respect their opinion. I think the idea of mortgaging up your house and buying stocks might be just a little bit too aggressive here. But right now, Scott, even though we've hit support, this is not really strong support where we're at. But I'm not surprised by the bounce we're getting into futures. And, I think that the real question is what's going on in the real economy. And I think that now that we're shutting down restaurants, that we're shutting down schools, there's, a lot of people are going to be without a paycheck. And those people are people who probably don't have $500 of savings in the bank. They can't cover next month's rent and their payments and, their car payment and everything else. And so I just see this thing getting much, much worse at a fundamental level.
Even those who are negative like you, like Mohammed El-Arian, who I talked to a few moments ago, agrees that things will be bad in the near term, but that you're going to get a big snapback on the other side. Do you disagree?
I think it all depends on the policy response that we get out of Washington. We desperately need a program like TARP or TALF that was used in the financial crisis to shore up failing industries. This idea that we're going to take on one failing industry at a time, like the airlines now with the $50 billion proposed bailout package. We saw this in the financial crisis. It starts to cascade, and the problems come faster and faster, and we see how long it takes to get Congress to react to something. And so we really need to have a dedicated pool of money that is available to step in and salvage some of these companies. And one thing I want to remind our viewers about on TARP, TARP was a money-making exercise for the government. The government ended up making money on that program. So, I think people should get away from the idea that we're bailing people out. What we're doing is the U.S. government's becoming a distressed investor and helping to sustain the economy. But, having said that, should we fail to get these sorts of programs in place quickly enough, there is an increasing risk that we could fall into a deep, dark spiral, that would be akin to a global depression.
But I want to be clear. If we get the things in place that need to be done, that wouldn't happen, in your estimation. Is that correct? The worst case scenario would be off the table?
I think so. And let me tell you why. When I talk about a global depression, I'm going to say it's a 10 to 20% chance right now. So it's not negligible. The thing that's bothering me, Scott, which is something I'm seeing absolutely no attention paid to, is the rapid increase in interest rates for countries like Indonesia, the Philippines, Singapore, Brazil, obviously the periphery of Europe, Eastern Europe. And these are countries that are in bonds which are paying interest in the currency of the country and sovereign debt. So what we're doing now is we're bringing into play the possibility that we could have a sovereign debt crisis on a global scale in these countries, just like we had the Asian crisis back in 1998. And it could take us to a whole different level, just as we've seen over the last week or so, as this cascaded into a geopolitical turmoil with Russia and Saudi Arabia upping production right at a time when our industries are the most vulnerable. So, I've written about this. I call it, I refer to this as the butterfly effect. As the cascade goes on, it's very, very difficult to predict what the implication is for, we'll say, it's seemingly unrelated markets that are now coming under stress.
I have to leave it there. But lastly, were you a buyer of anything today?
Not really. We are not, even though from a value standpoint, especially like in high yield bonds or investment grade corporates, we've only been cheaper than we are today relative to treasuries 15% of the time. We're not really seeing the kind of selling that you would think that you would see a capitulation.